Good evening, everyone. Welcome to the Westferry Fund report for August. This is our review of the August results. I'll just quickly highlight that the August fact sheet has been up on the website since the 3rd of this month, and you'll see from that we gained 4.1%, which extends a decent run over 5 months now, but even in the last 3 months, the fund's up about 9.5%. I will dive in a bit later in this video to some of the particular highlights of last month, but we're lucky this month to have with us the CEO of one of our core unlisted positions. So I want to dive in and deal with that first. So I'd like to welcome Paul Wagner. Paul is the CEO of Allmain Group, and he's spoken to us before. And a lot of you will recall that Westferry is a 50% owner, along with Paul's family, in Allmain. And we had Paul on quite some time back, and at that stage, the investment was a lot newer. We'd taken some steps to try and put together a few companies, and we set out a number of things that we hoped would evolve over time. So I thought it was a good chance to check in with Paul and see how all of that is going. So Paul, welcome. Thanks for your time. And to start off with, can I get you to just give us a bit of a rundown again of what Allmain does? And just with particular reference, if you can, to a question that came up in one of our earlier monthly videos, where there was some confusion around what Allmain does versus what you will, I'm sure, explain to us are called mercantile agents, those who are actually doing serving of documents in the field. So if I could throw that aspect to you first.
Yeah, certainly, Peter. So a mercantile agent effectively acts on behalf of someone who's a registered interest in something, a property, a mobile asset, a yellow plant, something along those lines. It intersects with what we do in real property. So Allmain basically is a mercantile agent, but we no longer, for many, many years, do document service or anything along those lines. We engage merc agents to operate on our behalf, dealing with real property. So we take possession of real property, repair it, maintain it, make it compliant, then sell it on behalf of mortgagees. The other part of the business is not mercantile at all. It's more about repairing, maintaining, and making compliant properties for trustees on a repeated cycle every 2 or 3 years. So mercantile we are, but we've morphed from that into a property management business with mercantile roots.
Okay. And tell us a bit about the competitive landscape. For those who want to go back and watch the previous videos, we spoke about that. But what's happened in this property presenter space over the last year or so?
Yeah. So the property presenters, Peter, basically morphed out of mercantile agents many years ago. So those merc agents who basically could take possession of a property and then make it ready for sale and sell it on behalf of the mortgagee became property presenters. And those property presenters effectively became national around 1990 and effectively a smaller number. So what's happened since then, I suppose, is that the barriers to entry, I suppose, have been around information security, which has become more and more important, but also I think about just developing solid processes, which in conjunction with the mortgagees, Peter. What else can I really say than that, I think? Yep.
There has been a number of competitors who have fallen away over the last year, which we expected would happen. And that has seemed to have eventuated. What's the reasons they've sort of given, as far as you know?
Yeah, thanks, Pete. So the reasons pretty much are meeting the new compliance hurdles, which are around InfoSec mainly.
And that's actually resulted in some of those coming to Allmain to license our InfoSec system, our particular software, which is a particular software that is now embedded in a large number of financial institutions, and allows us to comply with their sort of InfoSec requirements.
So some presenters move down the path of using off-the-shelf software. Salesforce was one which was quite prevalent for quite a few years. A handful developed their own in-house IP in their software. Allmain kept pushing through. It's quite a rare beast in this little presenter area. And these days, we probably stand alone, Peter, in terms of having a piece of IP in our software which meets the current InfoSec requirement for the major banks and is now able to be licensed to some of our competitors in this space.
And I mean, there's been a case of some of the competitors have fallen over. What's that done in terms of the ability to negotiate with some very large clients, banks in some cases, big four banks and other financial institutions in terms of the sort of fees that that might come to Allmain?
So over the last 20 years, we were pretty much price takers, Peter, and to a large extent. Lots of new entrants, ex-lawyers from the banks. Great example of a new entrant. So there's a lot of churn, I suppose, in who was doing this particular piece of work. What's transpired in the recent past is that they can't meet the compliance hurdles, they can't meet the InfoSec hurdles, they can't meet the process requirements of the larger mortgagees, and consequently they've just gone out of business. Or we bought two of them over the last period of time. One of them was a quality business called APAC, very well run, good client base, but effectively troubled over trying to keep up with the compliance requirements for the major banks. The second one, Tagmar, which we purchased earlier in 2023, just literally had just run out of steam, Peter, in terms of where they're able to get to.
Yeah. In terms of in terms of the competitive landscape, that's allowed both some better pricing. It's also allowed us to get in with a whole heap of new clients, as I understand it.
Oh, sorry, mate, I didn't answer that last part of the question.
But, yeah.
So from being price takers, as this landscape has actually reduced in terms of number of our competitors, we've been able to push through a range of price increases to all clients, as well. They'd be fixed price increases, management fee increases. That's actually demonstrates, I suppose, a small number of players left who can actually meet the requirements of the mortgagees to conduct this work. And secondly, I think that the acquisition of Tagmar in particular gave us access, Peter, to the trustee business. Now, trustees effectively, we do buy properties for them, we sell for them as well. In the middle piece is a whole cycle of repair and maintenance and compliance. Now, that when we bought Tagmar was rudimentary, to say the least, I suppose, done by emails, filing cabinets and God knows what else. We sort of overlaid our cloud-based processes on that business, won an open tender, the biggest of those trustees in Australia, and effectively then grown that business to now be half of our Allmain revenue stream, per month at this particular point in time.
Yeah, and that involves a book of many hundreds, high hundreds of properties for that particular client.
Yeah.
And look, there is the element of having a single client in that trustee space who's quite significant, but we are embedded to the extent that it takes quite a long time to get the software or the portal that we have approved by these organisations. That's being done, and in the case of the trustee, we're dealing with month to month 50 to 60 of their sort of staff who have to be trained up on that portal and have been. That's the case?
Well, so sort of weekly basis, Pete, interaction with 50, 60 staff. So if you wound the clock back, Allmain used to be sort of two big banks and maybe four small banks. After acquisition of Tagmar and APAC, we're now three of the major four banks and maybe 10 of the smaller financial organisations, plus two large trustees. So we've basically spread our revenue stream, Peter, which is probably tripled over the last 3 years, across a broader base of clients. The mortgagee business is still problematic for us. volumes we used to do, like in the heydays. We're talking now decades ago. Do 1,000 properties per year for one major bank, just one client. Repossess, 90-day cycle, default on mortgage, lose property, take property, sell it. You've got people now out there who've been in default for 12 months or 2 years that are still actually sitting in their properties today. So the mortgagee space, Peter, is quite flat at this particular point in time. And the old metrics you used to be able to use to forecast what was going to happen in terms of proportion of defaulting mortgages across the mortgage book Australia-wide no longer apply. You've got banks now talking hardship and vulnerability, and even concepts like sovereign citizens, which impact how the bank approaches taking properties. So mortgagee business for Allmain, in terms of volumes, are currently quite flat, albeit across a much larger range of clients than we had 4 years ago.
Yeah.
The trustee business is a bolt onto that, Pete, in terms of extra income opportunity, but using the same Allmain platform, which enables us to deal equally as well with mortgagees or trustees as they take various segments of our online platform, use them for their own bespoke purposes.
And you've spoken about getting access to a lot more of the those sort of financial institutions, and now 2 large trustees. Is there any further growth within new clients that you see? We've probably got most of the big ones, but there's potential upside from maybe one of the big 4 banks and other smaller entities. Is that a fair summary?
So look, big banks are very sticky. Our longest term client we've had for over 30 years of continuous service. Our second biggest client, 15 years. So we're dealing with organisations that both have a similar, legacy with some of these larger banks. To onboard a new vendor to a bank takes a lot of fuss and pain by the bank to actually get a new vendor on board. Okay, so once you've got one, unless you actually stuff it up, they keep with you for a long period of time. We now have ingress into 3 of the big 4 banks in Australia. We're on the retail and commercial panels for 2 of those 4. We're on the commercial panel for one, with an opportunity to be on the overflow panel for retail for that bank as well. A 4th bank of the big 4 is still a bit in the distance for us at this particular point in time. Most of the second tier lenders we're involved with in some particular fashion, but the opportunity for us for growth, Pete, apart from sort of waiting for another big 4 to roll over to us, is really in some of the legal service providers who deal with family companies, deal with trustees of various types, deal with receiverships. And they've heard of us and worked with us in the past with intersecting clients. And we're receiving contact from them now on a regular basis about supporting their services, dealing with real properties for that client base. And the bottom line is that our record keeping, our robust processes built around what the big 4 banks have been trying to achieve for many years now are demonstrated. Our information security is demonstrated, and then also we can do things at a lower price than they can do them, and we can still make money out of that. So that's the short version, Peter, of opportunity for growth. It's that mid-sized legal provider and some of the mid-sized receivers.
Yeah, and we're on those type of people. We've had approaches even in the last few weeks, which is encouraging.
We've had 2 sign-ups over the last month, and one we're currently engaging with in terms of presentations made, interest in pursuing using our services. So these, for us, I think, Peter, that if there's a trick in this, being a cloud-based business with a very well-defined set of processes, we need a size of client that we can basically work with through our platform. Doing what we do by email trails or whatever is a high-risk enterprise. You lose track of things, become liable for doing something you shouldn't have done. So companies who use our cloud-based system are of a certain size. They're not have to be the biggest four banks in Australia, but they're of a certain size. And that's our target market at this particular point in time.
Yeah.
I think
And
the big
so,
opportunity for us, Pete, is that like mortgagee business, let's become a no recourse lending country. At this stage, there are a higher level of people in default on their mortgages. We're seeing receiverships at record levels for many years. It hasn't yet flown through into possessions in terms of MIP work. It will happen at some point in time. Now, whether the new normal is a mortgagee, a big bank or a mid-sized bank that's prepared to accept less than they would have 5 years ago or 10 years ago, there still must be possessions occur. And when they do occur, our client base at this stage is much more than what it was 10 years ago. So any uptick at all, we will actually feel quite rapidly.
yeah, and so that's how we set the business up, is that if that happens, and it may not, but you would think it's a cyclical thing, and if there is an upturn, there's significant upside for Allmain. But we have set it up so that even on the current numbers, which are really bumping along the bottom and continue to, that we're earning an adequate profit now in that section
It
of the
makes money
business.
now, Peter,
Yeah,
with a broader mix of clients that all use our platform, and that's important to us in terms of being able to control the goalpost we're working with here. And they all use the platform. It makes money now. The trustee business has supported us to increase our profitability. The trustee business will grow. We're moving into enhanced project management work with trustees, which will give us a higher turnover with a markup on the cost of building and construction on the way through. But the real opportunity here is for any uptick at all in MIP work in the short term or mid term. As I say, I'm not prepared to forecast how or when, because everything you used to work on no longer makes any sense. But unless you believe in no recourse lending in Australia, and if you do, my advice is go and borrow as much as you can now. Go and buy a property, and don't pay any bills, and see what happens. That's where things are at this point in time. Yeah.
and look, let's assume that is the case. We're not going to go into exact figures in this call. I'm happy to speak to any individual investors about numbers, but things are going well based on the FY25 numbers. So let's talk capital management. At the moment, we started sort of 18 months ago with about $1 million in tax losses. We've managed to use a good chunk of those in FY25, despite the business paying quite a lot of interest on debt. That the profit from last year was basically used to pay down debt, and with some small dividends, but through one part of the business, but mostly used to pay down debt. Fair to say the plan ahead for this year is to continue paying down debt until the rest of the tax losses are used up. And once we get in a position, probably later this financial year, when we're paying tax again, we will likely be at a level of debt that's probably comfortable for the business to stay there. Westferry is the actual lender, and we won't be seeking to have it paid down anymore beyond that at that stage. And the business can move to turning those profits into dividends, basically. There's the only other area of capital management you might consider is whether there's another opportunity like the Tagmar acquisition. Is it fair to say that at this stage we think there's really two major competitors still in the market? Is it fair to say they don't really have anything that we particularly want, and we think we can probably get organically over time what they have without actually having to pay them for it? Is that a fair summary?
I think, look, the major banks will always want at least two on their panel to start off with. So you can't just buy someone and think you're going to be the only provider. So buying someone, you may open up an opportunity for someone else to actually fill the vacuum.
Yeah.
But I think having a complementary client base, Peter, is the most important criteria for acquisition. At this particular point in time, there's no one out there I can think of that has a complementary client base to what we currently have now.
Yeah.
And I think that it is still a moving target, but I don't see acquisition in the next 6 to 12 months as being something that's on the table at this particular point in time.
Yeah. And so, yeah, I mean, all going
Organic
well.
growth of the business,
Yeah.
keep bolting on these smaller clients, but within the parameters we want to work with those clients, have to meet a certain criteria to actually want to work with them. Keep working on our enhancing our fee structures, renewals of deals with clients, rolling the contracts over, just basically bulletproofing the business, I suppose, for the next 2 or 3 years, and then look for opportunities. But nothing sits immediately on the horizon as an action target.
Sure. And yeah, later this financial year, moving to essentially closer to a very, very low net debt,
Yeah,
and tax payments which allow fully franked dividends. So in Westferry's, from Westferry's point of view, if I can just look at that for a minute, we've moved from an initial point of amount of debt to a level of debt at the end of this financial year that is very, very comfortable for the business, given its earnings profile. And like Paul, will be the recipients of fully franked dividends, which
yeah.
will go into the performance of the fund. So, Paul, thank you very much for that.
You're very
I'll
welcome.
let you
I think your
go from
investment, Peter,
here.
was actually very timely. At that particular point in time, as things turned out, being able to buy Tagmar and APAC at that stage really has made a big difference. And the existing All Main IP extended across to the trustee business has really been the icing on the cake. So
Yeah,
where we go from there, there's no clear plan acquisition wise, but either organic growth in those businesses, Peter, will give us a good outcomes next 2 or 3 years to start off with.
yeah, brilliant. Thank you very much, Paul. You're welcome to stick around or head off. I'll just jump now into some of the other stuff from August. Basically, as I said, we had a good month, up 4.1%, and we were ahead of the ASX 200. The small ordinaries index had a blockbuster month. There was a bit of a return to form for the real micro caps. The Just touching on a few of the companies. So one interesting point, and I'll talk myself up here, was with a company called Harmoney. HMY is the code on the ASX. Those who looked at the last monthly video call will recall that I spoke particularly about this company, indicating that it probably wasn't the greatest quality company, but was probably nearing a point of inflection during the August results. That became quite apparent. They were excellent results, and the share price did very well. It was up significantly. Uh, just looking exactly how much it was up. Um, it was up, yeah, 26% during August, on the back of those results, which really showed that it had sort of hit that point of inflection. The other thing is that it probably, look, it's a personal lender. It's never going to be the greatest business, but they do seem to have an approach that is a bit different to most competitors. They don't rely, as most competitors do, on brokers. And so the big benefit to them is that through their systems, they have access to excellent and quite a long period of data now on their clients that I think is among the best of their competitors in this space. And they say that allows them to better judge. I've heard this story before, and that hasn't turned out to be the case when general market conditions turn bad. So look, it's never going to be a company that we're diving into, but look, we did very well out of it the last couple of months. It's still cheap, on some metrics, and so we've maintained a position there. The other one was Fiducian, which is one of our larger holdings. It's a financial planning and investment management company. Um, we spoke about this in our Coffee Microcaps interview, which was published in late July and is on the website. And Fiducian had a really good month, up 21% in August as well, on the back of really good solid results. Another big development in August was our unlisted position in a company called Nebulaw. So Nebulaw was an unlisted legal practice management company that we invested in about 2.5 years ago. Um, and it was part of a quite a painful and lengthy private sale to a Canadian listed company called Dye& Durham. And we were to be paid in two tranches. We received a small upfront payment in August last year, and during August this year, we received the rest of that money. So that turned out to be a really profitable purchase and sale for us. We invested 1.6 million into that company and ended up with just over 2.6 million all up out of it. So some of that profit had been marked up as we went, but August saw the rest of that profit, and that helped both the monthly profit of 4.1%, but also increased our cash position. And you'll see that the pie graph on the monthly report has probably changed more than it has for a long time in the last month. So the amount of shares and cash has increased, and the portion attributed to unlisted equity has decreased, mainly because of that sale of Nebula. In September, you'll see that unlisted equity slice of the pie decrease further because in the last week we have sold our position in Covertrue, and you can go back through the website to see that Covertrue was another unlisted investment in a company, one of our best ever investments. They manage the wrapping or branding of vehicles, but only did fleets. So very large sort of fleets of usually at least 20 and usually up into the hundreds. We invested in that company, bought about 10% of it. Have done very well through a flow of dividends from it. We actually introduced that company to our largest listed company, Connection Mobility, CXZ. Now, Connection, I've spoken about many times before. Their main business is a essentially software that manages the mobility of loan vehicles for car dealerships. So whenever someone's coming in to get a car serviced or needs to come to and from a dealership, they will use this system, and it's embedded in around 3,000 dealerships in the US, primarily with General Motors. That company has built up quite a cash box, and they've been looking consistently for an outside investment. I introduced them to Covertrue in the background without me knowing. They developed that further, and Connection Mobility actually made a bid for all of Covertrue. A good chunk of investors in Covertrue didn't want to sell. That includes the CEO and the managing director. About 30%, including ourselves, did decide to sell. The question, I suppose, if it's such a great investment, why did we sell? I think it was probably a fair price. I think Connection probably bought reasonably well. Part of our decision to sell was the fact it was an unlisted position, and I am keen to move the fund more back to a more liquid vehicle where we're primarily invested in listed positions. And so the thing with these unlisted purchases, you don't get to sell them when you want to, right? So things are going very well at the moment in the unlisted space. The markets are buoyant, plenty of liquidity, but it is ultimately a cyclical business. Car sales are very strong in Australia, and that feeds directly into fleet purchases and the amount of work that they're getting. So it was probably purchased on around, 4 times FY25 EBIT, which is a reasonably cheap price that we sold it into. But it doesn't take much. You only have to go back 2 years, and that profit was a lot less in that business. If there's a cyclical downturn again, you both have the lower profit, a lower flow of dividends, and you can't get out. So the buyers dry up as the cycle changes. So we decided to sell because it was a good opportunity to sell it with what we think could be a reasonably high point in the earnings cycle, even though the multiple wasn't all that high. And two, because we are also the largest shareholders in Connection, right? So as the shareholders in Connection, we still own a good chunk of Cover True in that indirect way. So that flows through to this month. It'll add to our profit a small amount in September, but it'll again increase the cash position and lower that unlisted slice of the circle, and probably hopefully makes us a bit more attractive as an investment vehicle when people see that we've got a good chunk of assets in highly liquid positions. I will put up a new list on the website in the next week or so of the full list of our positions now that Cover True and Nebulaw are gone, and you'll see that that has changed to a more liquid outline. The last thing I'll just point out is AF Legal, our second largest listed position. Look, the results for that in August were reasonably well received. Nothing blew the market away, but the price did go up and stayed up from where it was prior to the results. I'd like to think that there's the first small signs there, although there's a lot of messiness in terms of one-offs. There's still the first signs there that of what we're trying to achieve there. The underlying results are, I think, looking really good, and will continue to improve. And the messiness of that in terms of the one-off expenses, litigation costs, and secondly, the implementation of a practice management system that will set us up for the next decade. We'll finish up this financial year, and that's an FY27 story where the underlying results will continue to improve, and the market will really start to take notice in about 12 months from now. There was quite a detailed investor call done with the CEO, CFO, and myself for AF Legal. That's available tomorrow on the investor site for AF Legal. So it's aflegal.com.au, and in the investors and shareholders section there, you'll have access to that video conference, which does a deep dive into exactly what we're trying to achieve there. But I think that's something to look forward to for the fund, in 12 to 18 months' time. But look, in the meantime, September has started well. The market is actually, well, the ASX 200 is actually down 1 to 1.5% so far for the month, whereas we are up for the month. Still early days, but hopefully we can carry that through to another reasonable result. Thanks very much for your time. We'll try and get another CEO or two from our positions in probably AF Legal, and another couple of positions in the next few months. But otherwise, look forward to seeing you in about 4 weeks' time for the September update. Thanks all.